Now, let's try to understand about the corporate debt and the credit derivatives. So, whenever we are talking about the corporate debt, in general, the borrowing is done for greater than 1 year period, and this falls under the category of capital markets and not the money markets, where the typical borrowings are for a very short term period, typically less than 1 year. So the debentures, different kinds of loans the company is getting into, or even preference shares, all of them will come under this corporate bond kind of a segment. And here, when there are multiple kinds of instruments that are there, what clearly differentiates between the instruments is the security that is associated, the kind of collateral that is attached to it, the risk of default that is associated with the issuer, how that risk of default is mitigated through various credit enhancements. So those things are the differentiators between the different kinds of instruments. For example, if we see the preference shares, the interest, which is typically the dividend on the preference shares, it's a fixed amount, but that can be paid only when the company has made a profit in a particular year. But when we look at the traditional loan stock, even if a company did not make any kind of a payment in a particular profit in any particular year, still the interest on the loan stock need to be paid. So the payment conditions are different. Similarly, the security that is associated with the issuer or the credit ratings of the issuer play an important role, and the higher the risk that is built into it, the higher should be the yield that that particular bond should be giving. And today, the world of corporate debt, the market, the secondary market for corporate debt has really expanded tremendously because of the use of credit derivatives. We will be seeing slightly at a later point. Credit derivatives are one of the powerful derivative securities built on the top of the credit instruments, with credit instruments being the underlying securities. Again expanded the market for the corporate credit or corporate debt. So at the end of the day, if I have to really specialize in the world of corporate debt, I have to really understand the world of credit risk and how do I price this credit risk as a part of the valuation of the financial instrument. That entire thing has to be understood in a large extent. Now, we know the very basic fundamentals that in any investment, the higher the risk that an investor is taking, to motivate the investor to invest in that particular security, the expected returns need to be much higher. And from a bond perspective, if I have to talk about the same, the yield that that particular instrument is going to offer should be higher compared to any other. So probably if I'm looking at a treasury bond versus a corporate bond, I know the chances of default of a corporate bond are higher compared to that of a treasury bond. So which means if at all I have to be motivated to purchase a corporate bond, the return that I typically should expect in a corporate bond is much higher compared to that of a treasury bond, which means the yield that is generally offered by the corporate bond should be higher compared to that of a treasury bond. That is the only motivation for me to invest in a corporate bond vis-a-vis a treasury bond. Now, when I am talking about the word higher risk, there are two major dimensions of this risk which we are bringing in. One is the chances of default of this corporate entity. The company which has issued this corporate bond, it might fail to make its payment of both interest and principal when they actually fall due. So that risk, which the company may not be in a position or may not be willing to make the payment of the interest and the principal whenever they fall due. So compared to the government, the companies have a higher risk that they may not pay. So that is what we are bringing in as a risk associated with default. And two, we are talking about a liquidity risk. Okay, let's say I have invested in a corporate bond, and let's say I have 1 lakh or 1 million units of that particular bond, and suddenly today I want to sell off those 1 million units. It's not that easy for me to sell all of them. It may take so much of time for me to dispose all of them, because there may not be a big secondary market that is available wherein I may be able to sell off all the 1 million units of that bond without changing, without compromising on the price. So that is what I talk about, the liquidity. How comfortably I am able to close off my position, sell off my existing position, how comfortably I am able to do that without compromising on the price. Right? In some cases, it becomes very, very difficult. Probably I may not be able to sell off my 1 million because there could be quite a few restrictions that I may be undergoing in terms of selling them. That restrictions are typically called as covenants, some do's and don'ts associated, or the market may be so small that getting rid of 1 million units may take a minimum of 10 days for me. I may not be able to get them, dispose them within 1 day without impacting the price. So what is generally observed is every corporate bond, it has to some extent or the other a default risk as well as a liquidity risk. Depending on how high these two kinds of risks are, we see that their expected yields above the risk-free rate are higher by that much extent. So that's a clear differentiator. That is what we call as the spread. So higher is the probability of default, or higher is the liquidity risk. I see that the spread from the risk-free securities is going to be higher. And remember, these two are not independent. There can be a good amount of interdependency, especially if you look at a situation where the financial crisis has occurred, right? Okay, there is a good chance that the company will default. So I will not get my money. And even thinking that the company will default, if I want to be proactive on that line and I want to sell off my investment in the market before the company declares default or bankruptcy, I want to sell off my stake, my units in the secondary market. It might very well be possible that I may not have the relevant market where I can sell off my units for an appropriate price. So I am actually exposed both to default risk as well as the liquidity risk. And what I see is when the markets are performing very badly, the correlation between the default risk and the liquidity risk is going to be tremendously higher. Right? And because of all these things, what we can generalize is the corporate bonds, they are comparatively more riskier compared to the treasury bonds, keeping all the others say the same. All the other aspects, even though they are the same, we see that a corporate bond would be much more riskier compared to an equivalent treasury bond, which means the yield associated with the corporate bonds need to be much higher. And generally what happens as a procedure is, any bond, if I have to really try to find out the probability of default, or the expected loss associated with the default for any of the bond. From that, for that particular bond, use the process of bootstrapping. Bootstrapping is a mechanism wherein we are trying to come out with the spot rates from the coupon rates, right? Use the phenomenon of bootstrapping where we construct a zero coupon yield curve, which is otherwise called as the spot rate yield curve, for different bonds which are issued by different companies which fall under the different credit rating categories, and try to compare them. Generally, what we see as a part of the spot rate curve is we see an upward sloping kind of a spot rate curve. As the term to maturity increases, the spot rates are going to be upward sloping. So generally, okay, these could be for, let's say, a very highly credit rated firm. Probably this could be the rates for the next rated firm, and these could be the rates for a non-investment graded kind of a firms as well. Now what we do is generally we compare these spot curves with the treasury. Treasury is expected to be more risk free. So I try to compare this with respect to the treasury and see what is the spread that is coming out between the rates of this particular bond versus the rates of the equivalent treasury curve. Now, this difference is what is contributed to the spread, which is a measure of both the default risk as well as the liquidity risk that is associated with the investment. And the investor can expect a significantly higher returns by investing in the corporate bonds because the risk is much higher, so he can expect at least he would be compensated for that higher risk that he is taking. But at the same time, the chances of loss are also much higher when we are targeting the investment in corporate bonds. Now, if I have to look at the expected default loss, you see here a 1 year maturity, the treasury zero coupon bond is yielding me 6%, whereas the corresponding corporate zero coupon bond is yielding 6.65. Now, if I look at the present value of both of them, the present value of the first one comes out as 100 e to the power of minus 0.06. Whereas for the second one, I get it as 100 e to the power of minus 0.065. Now, whatever the PV1 and PV2 that I get, right, corresponding to that, so I'll generally see that the PV2 will be less than PV1. So the difference, whatever is coming out, PV1 minus PV2, is actually contributing to the expected default loss, right? Expected default loss in the dollar terms is what is coming out as PV1 minus PV2. Now the same thing if I am doing as a proportion of PV1, the same thing is coming out as the expected default loss expressed in percentage term. Now I can do that for 1 year, 2 years, 3 years, which will give me a very good clarity in terms of what is the expected default loss of a corporate bond, which can very well be obtained from the typical zero coupon yields of both of them. Now, when I look at the actual default losses, see, many a times what happens is actuals come from historical. Whereas when I talk about the one in the earlier slide, expected default loss, it might so happen that I may figure out a little bit of more percentage in the expected default loss compared to what have occurred in the past, because that might be driven by the fact, which is the perception of the investors who really feel that the future default levels are much more higher compared to that of the past. Generally, whatever is the yield which or yield spread which a corporate bond has over the treasury bond, we see that there are four elements that go into it. Now, one is the expected default. I expect that this corporate bond is going to default. So, corresponding to that expected default, there needs to be a premium. And higher than expected, I expected that the default chance is 1%. But there is some level of volatility around that, which means there is a possibility that the default is more than expected. So even for that default being more than expected, there needs to be some compensation. So that is what I am calling as a credit risk premium. Then the other component of that spread is the perception of the investors, where they really believe that in the future, the losses might be much more higher than what have occurred in the past. So even that is adding up. And finally, I could see an illiquidity, which is more associated with the liquidity risk. So whatever is the premium that is associated with the liquidity, wherein it becomes difficult in terms of selling off the bond, selling off the underlying asset without compromising on the price. So the modeling of this is a very difficult task. A lot of research is going on in terms of coming out with various models for assessing what should be that additional yield over that of the treasury bonds. Lots and lots of already heavily used models like option pricing models, the Black-Scholes-Merton model of pricing options, wherein the equity volatility is being used as an estimator of volatility, which will help in terms of finding out the risk of default. We know that there is a structural credit risk model called Black-Scholes-Merton model, or in fact only the Merton model, which uses the traditional Black-Scholes option pricing mechanism along with the assumptions of the Black-Scholes option pricing mechanism to determine the risk of default. So that model can very well be used for assessing the default risk or even the premium for the credit risk. The credit default swaps are typically used to assess the premium that is associated with the credit risk. So different kinds of models are used in finally trying to arrive at the yield what the corporate bonds should give over the traditional treasury bonds. And now moving on to the other side, the usage of credit derivatives. Today, the credit risk management has become very powerful, have become very lively because of the use of the credit derivatives. And as we know, credit risk is something which is an inevitable problem for the banks. So they have to look out for the different mechanisms in terms of mitigating that risk. So they have to look at various innovative instruments which can help them in terms of reducing that credit risk. And credit derivatives are a very powerful instruments. It's not just one, there are wide varieties of credit derivatives. They are all powerful instruments which can help in terms of mitigating the credit risk. And what is the credit derivative in simple terms? I say that the payoff of the credit derivative, it purely depends on the credit worthiness of the one or more entities. So the credit worthiness of the borrower, or in some cases we call it as a reference entity. So the credit worthiness of one or more reference entities is what is deciding the payoff. And now there are wide good number of credit derivatives that are prevalent in the market, but the very popular of them is a credit default swap. It's a very interesting instrument. right? The way it works, okay? Let's say A has borrowed from B. So let's say I call it as B is the lender and A is the borrower. Now B is exposed to the credit risk. If A defaults, B will be the sufferer. B will lose drastically. Now, to protect itself from the possibility of loss of A, B tries to enter into what is called as a credit default swap with C, taking the reference entity as A. What does that mean? If A defaults, reference entity is A. So if A defaults, C has to compensate B for the loss. That kind of an instrument where B is trying to take protection from C against the risk of default of A is what is called as a credit default swap. So this C will compensate B only if a particular credit event has occurred. Now the credit events could be defined quite comfortably in the document. So bankruptcy of A. If A goes bankrupt, C will compensate B for the amount of loss. Or if A's rating gets downgraded, the same thing can happen. If A is unwilling to make the payment, the same thing will happen. If A is not able to make one principal or interest or coupon payment, then also this may get triggered. Or cross default, it's a very interesting word. If A default on some other bond, not the one which B has purchased, but A has defaulted on its other bond, but did not default on B still. But that is called as a cross default because the chances are very high that it will default on this particular bond also. Now, any of these things can be highlighted as a credit default event, which has to be very clearly highlighted as a part of the agreement document. Now, what generally happens is in this transaction, B is called as a protection buyer and C is called as a protection seller. So, C is promising that it will protect B in case the default event occurs. So, to keep that deal happening, the protection buyer at regular intervals of time is paying a fee or sometimes called as a premium. Some premium is paid by the protection buyer to the protection seller. So, in case the event occurs during that particular period, the seller makes the entire agreed payment to the buyer. So the buyer B, protection buyer B, who is the lender of the original contract, he is to a large extent protected from the default of A. But in case no default event occurs during this period, obviously he has to forego his premiums that he has paid. Generally, the premiums are paid on an annual basis. B has to forego all the premiums that he has paid, but he would have enjoyed the protection that he would have received during that entire period. So, in short, if you look at the credit default swap, actually works more like an insurance premium for a life insurance policy kind of stuff. I keep paying the premiums at regular intervals of time, and in case the loss occurs during the contract period, the insurance company compensates for the loss. And in case the loss does not occur during the period, then the policy holder simply forgoes all the premiums that he has paid. The same thing goes true in case of the credit default swap also. And here two important things to look at. The settlement can happen either in the pure cash form or a physical settlement form. Now when I talk about the pure cash form, okay, let's say A has defaulted. It doesn't mean if A has defaulted, the recovery rate is not 0% all the time. Probably if the recovery rate is 70%, it means only 30% is the loss. So C will be compensating B only for the extent of 30%. So looking at the recovery rate, whatever the portion of amount that cannot be recovered, only that much would be compensated for the loss. But here the biggest difficulty comes in terms of how do I find out the value here? How much of recovery can I expect? It's a time taking process. Determining it is very, very difficult. Now this is where the quotes are obtained from various market participants, and based on the quotes the settlement amount is decided. But on the other side, when I talk about a physical settlement process, it's as good as B will give the bond, whatever it was holding of A, B will give the bond to C, and C will make the full notional amount payment. Face value is paid by C. B will hand over the bond to C. Now it's up to C to make sure that it will recover from A. That is what is a physical settlement kind of a process. Full notional amount is paid and the security is ownership of the security is taken from B to C here. See, this is a very good mechanism, especially for those lenders. Okay, in this example also, B has lent to A. Let's say as per the limits, B has touched the limits. B can't lend anything more to A. Right? B has already its internal credit limit touched. Now B can't give anything more to A, but A wants more money. Now, if B lends, it is exceeding its limit, but if it does not lend, probably the relationship with A is broken because A can approach some other vendor. Now, this is a dilemmatic situation, and this is where we are talking of B can lend to A but immediately protect itself by getting into a credit default swap with C. So virtually, because of this protection, it is still able to lend to A because this protection is really looking as if it has not lent anything to A or as if there is no default risk that is built in as a part of the new loan that has been given to A. So wherever the relationship with the client needs to be preserved, but still want to lend a little bit more, this is where the credit default swaps can come in more and more handy. Then similar to a credit default swap, we can talk about a few other instruments like credit linked notes, where we talk about the basic security plus embedded credit default swap. So we talk about the original bond, and along with that bond, we are talking about a credit default swap, which is a protection kind of a mechanism. So again, this is also a kind of a tool which can provide protection against the fluctuations of the default. It's again a useful way of stripping and repackaging the credit risk, which works exactly in the same way or more or less in the same way as the credit default swaps also. And along with that, we also have another set of tools called credit spread options. Now here what is important is the spread. Spread is the yield of the corporate bond minus the yield of the treasury bond. So this is some X, right? So we are talking of the option on the spread of the yields between the two. Now, if the spread exceeds some level, that level is again called as the exercise spread or the strike spread, just like any other option terminology. If the spread exceeds a particular number, the payoff is done. And this is where we talk about the difference between the value of the bond with this strike spread and the spread that is prevalent in the market. So there could be wide varieties of instruments that could be available in the market to provide a protection against the credit risk. So we really need to understand a wide variety of instruments which are specific to the corporate bond world, different kinds of bonds, their credit risk, how it can be reduced using the credit derivatives. And that is what is intended to be discussed as a part of this particular session. All right.